So hello everyone, welcome to the Monkey Stock Club. For those who are new at this channel, my name is Monkey B. I love to go out there and finding some nice stocks just for you. So all you have to do is just watching this video and decided if the following stock could be something for your portfolio. So please feel free to hit the subscribe button below and become part of the Monkey Stock Club family, so you will never miss a video again. Please be aware that everything I say here is just my opinion, as I'm not a professional investment advisor. As you can see, I'm just a monkey, but nevertheless, I love to analyze stocks for you. So let's stick around and discuss it now. Question is Zoom still a buy? So I will try to use my high growth investing strategy. So first, an HGI score is calculated for the selected share, the Zoom share, according to a simple point system for each share. So the score consists of 6 criteria, which I will present it within the next slides. And for each criteria, you can get 0 to 3 points. And in total, a share can therefore receive a maximum of 18 points. And this is really a nice indicator for a high growth investing share. At the end of this video, I will show you also the fair price by Peter Lynch. So let's get started. So Zoom video communications. First of all, we use the key figure enterprise value divided by sales actual. So the enterprise value is a measure of the value of a company regardless of its financing. And if you divided the enterprise value by sales, you can get an important ratio for estimating an valuation of a fast growing but sometimes still loss-making technology company. So if we take a look into Zoom video communications, they have an EV of 143 billion US dollar divided by a revenue of around about 1.3 billion. So we have a total in value of 106. So as we are above 12, as you can see here, we received 0 points. So far 0 points. The second KPI we want to look into is the gross margin within the last 12 months. So the gross margin is the percentage of the sales that remains with the company after deducting direct production costs. So if you take a look also in the income statement, you see that overall, if we take the sales and reduce it by the direct cost and divide it by the sales, we end up at around about 70%. So 70% means 2 points, as we are between 65 and 75. So our first 2 points. The next one, the rule of 40 score. That's really a simple key figure for assessing the efficiency of a company growth and also the quality of its business model. So the ratio is calculated by as the sum of the sales growth rate and the free cash flow margin, and the higher the value is, the better the business model of the company is. So every value above 40 are considered as an attractive business model. So here we talk about 243. So the business model in general and also the activity is really high. So we are far above 50%. So 3 points, very nice. The next one, sales growth within the last 12 months. As you saw in the slide deck before, we have 190%. So above 40, fully above 40, so 3 points. And here also a screenshot from the internet. Very nice development from 2017 up to 2020. So here you can see the increase of revenue and also the earnings are also a nice development, especially within the last 2 years, or especially also within the last months due to the Corona crisis. So a very nice development. So again, 3 points. Next one, the debit ratio. So the debit ratio is calculated by dividing the sum of the current and non-current liabilities by equity. So the last quarterly figures are used for this calculation. So we end up at 0.06. So that's far below 0.5, 3 points. Very nice. Here we just use the debit of last quarter, 72 million divided by the equity last quarter, 1.2 billion. So we end up at 0.06. And last but not least, the PEG TTM, so the last 12 months. So the PEG is one of the most important key figures for the assessment of an already profitable growth stock. So it calculates the ratio of the PE and the profit growth. So if the ratio is between 0 and 1, it's really a nice indicator if we can buy a cheap stock. So if we talk about an undervaluation of the stock. So the PEG can only be calculated for companies that are already sustainably profitable. So here we have for the PE within the last 12 months, 658 divided by a huge profit growth of 2,570%. So if we compare the EPS to the value 12 months ago, we talk about 2,570% profit growth. So here overall we have 0.26. So here we have also a value of 0 between 1. So sorry for that. Here just one mistake within my slide decks. So we just receive 3 points in addition to that. So not 2 points as we are far below 1. So 3 points. Sorry for that. And here also a screenshot of the earnings per share within the last quarters. So the market always beats the let's say overall assumption of the people. So here we have also around about 0.9 EPS within Q3 2020. So additional 3 points, not 2. And here below also an indicator for you that in every year we have a stable high growth of sales, and especially in 2020 as we struggling with the Corona crisis and everybody is working from home. Zoom has a very, very nice boost. So as I mentioned, in addition to the 14 HGI score, which is really a really nice score for an indication of an high growth stock. So this is the result of the analysis. So quite a good score from the current point of view. And in addition to that, I just take a look into the fair value by Peter Lynch. So if we use the EPS multiply by the profit growth, we can calculate a fair price. So the closing price 516. The EPS the EPS currently 0.78. And if we take a look into the estimation for 2021, we have around about 2.54 earnings per share. So we talk about 225 profit growth, the estimation for the next fiscal year. So multiply by the EPS for the next fiscal year, we end up at 573. So plus 11%. So the question is the price already at the all-time high? Will the price still increase within the next months? So in general, the company has an easy to use and super functional video conferencing tool, and Zoom was at the right place at the right time with the IPO, and has experienced a big boom within the Corona crisis with the hashtag stay at home in a way the management could never have imagined in their wildest dreams. But still the questions, would I invest into Zoom currently? So it's difficult to answer, but from my point of view currently, I wouldn't buy Zoom. The Zoom conferencing is not rocket science, so there will be more and more competitors in the future who will involve Zoom in a price war. And within, let's say, the next 3 to 5 years, user-friendly video conferencings will become a commodity. And so there will be a lot of companies who will also offer a very comparable video conferencing, also with a comparable quality and extra functions. So until then, Zoom must create other unique selling points and develop into new markets to be, or let's say to have still a success story and to continue the success story. So that's from my side. I hope you enjoyed the quick update to Zoom as everybody talk about Zoom. I hope you enjoyed it, and I would really appreciate if you put or hit the subscribe button below to become a part of the Monkey Stock Club family. So it really helps me to continue with a weekly update. I will always keep you updated. So yeah, so then I wish everybody a nice day, and we will see each other hopefully. Bye bye.